Good afternoon and welcome to the Summer 2017 Linneman Associates Capital Markets webinar presented by Linneman Associates and Valuate Software, a product of Real Estate Financial Modeling. This is your host, Bruce Kirsch, founder and CEO of REFM, producer of Valuate Software, and provider of financial analysis tools and training to the CRE business nationwide since 2009. We're very pleased to have an insightful program for you all today, which will be presented by Dr. Peter Linneman, founder of Linneman Associates, which, for those of you who do not know, is a strategic and investment analysis advisory firm. We're using the GoToWebinar platform, and I just want to address a couple of housekeeping items before we get started to make sure everyone is comfortable. On the audio front, all of the participant audio is muted, meaning we cannot hear you as a participant. That is by design, and that will remain the case throughout the entire webinar. If you're attending by computer, please now take just a moment to familiarize or reacquaint yourself with the small floating control panel box, which is on the right-hand side of your screen. We will be showing the slides in the larger viewer window, which is on the left-hand side of the screen. If you would like to download the slides, you can find the handout section of the control panel and click on the file name and it will download to your local machine. You don't have to have the slides up during the presentation because we'll be showing them in the viewer window, but you are welcome to keep them for the future. We have reserved 15 to 20 minutes at the end to answer participant questions. Please do feel free to submit them on a rolling basis by clicking in the questions field of the control panel, typing in the question, and then make sure you click the send button. If at any point during the webinar you get disconnected, just reconnect by clicking on the link that you used initially, or dial back in on the same line that you dialed in on initially. And without any further ado, I'd like to introduce the presenter, Dr. Peter Linneman, CEO of Linneman Associates. Peter, over to you.
Bruce, thank you very much, and welcome everybody. It's a gorgeous day here in Philadelphia, and I hope it's a nice day wherever you're at. We'll go until about, hopefully I can wrap up my official comments around 20 till 1 or quarter till 1, and we'll leave that remaining time until 1 o'clock for questions. So let me start out. Let's go to the first slide, and it says actual versus trend real GDP. The red is the long-term trend. I've mentioned every time that I use here the trend from 1969 to 2007, but you could use the trend over almost any long period, including back to 1800. And you would basically get that same trend line. The blue is actual GDP in real terms, and throughout the presentation, whenever I mention real, all we've done is adjust for inflation using core CPI. And what you'll see is that real GDP in the blue has been on a long upward swing since basically the beginning of 2011. It has been a pretty steady upward swing. It's been growing at about 2.2%. That's the good news. One more piece of good news, it's at its all-time high. We're the richest large country in the history of the world. And it's continuing to show all the signs that it will continue to grow at about 2.2%. What's the bad news? The bad news is that we've entered a period of, I believe, cyclical trailing the long-term trend. The long-term trend, just to give you a sense, is just about 3%, which is roughly 2% productivity growth and just a little under 1% population growth. That long-term trend we've followed over almost the entire history of the United States. We've had periods of being notably above it with GDP and periods of being notably below it, but we've always drifted back. This current period is some $3.2 trillion below trend GDP. And as I've said in the past, it captures the I feel good, we're the richest large country in the world's history, but it also captures the dissonance that's out there, which is, but we're not doing as well as we should be doing by any long-term trend. If you dissemble this gap is about 50% attributable to the underproduction of single-family housing over that time period. And in fact, normally, single-family housing would be 20 to 30% above trend by this point in a cycle, and it remains 25 to 30% below trend. So instead of powering the economy forward, it's dragging the economy down. That means on the good side, there's a lot of legs because people do need housing. We've underproduced it. And the other hand, it does mean that we have to solve the problem of housing. And it's not even just housing ownership, it's housing production, whether it's owned or rented, single or multi. There's a fundamental underproduction. And so when people say, yeah, but young people don't want to own a home, they got to live somewhere. That hasn't changed. They have changed in the sense they're staying with their parents and playing video games. Almost 1.25 million are doing that versus long-term patterns, almost all males. But this gap, I believe, ultimately closes. I have no idea of when it closes, but I believe it will close. It's closed every time since 1800. If you go to the next chart, it's the number of people employed. You can see that it's up about 8 million from its previous cyclical peak in 2008. I put a marker line just to help your eye. This continues to grow at about 2.2 million jobs a year, and all signs from the labor market are that that pace more or less is going to continue for another year or two. I always caution people because we're adding about 2.2 million jobs a year, but we're only adding about 2.5 million people a year. And it's unlikely that 80% of all the population growth will always go to work. It would be more sustainable long-term at around 1.7 to 1.8 million. However, what you're doing is making up for that big dip that occurred during the recession, and there's a catch-up phenomenon. If you go to slide 4, you'll see the payroll survey summary. And what I give you is the U.S. and the 10 largest metropolitan areas in the United States, their unemployment rate, and the year-over-year percent growth in jobs. So just to look at the U.S., it's about 4.4% unemployment rate. That's quite strong. However, there is a reduced labor force participation that overstates it a bit, and we've added 1.6% year over year to employment. That's the unsustainable I was mentioning because the population is growing at about 75 basis points a year. So you can't do that forever. You can see the strong areas and the weak areas. Houston is quite notable in that its unemployment rate is 5.7. However, given the shock that happened to the energy sector, it has recovered from basically adding no jobs to over the last year, it's grown at essentially the U.S. rate. Some of you will remember 2 years ago and a year ago, I said there would be a flattening out of Houston growth, but Houston has fundamental strength of low-cost housing, very low barriers to entry, values entrepreneurs, low taxes. It has strong growth fundamentals and will continue to grow, and I think you'll see even more strength. You see Atlanta has really stepped on the gas pedal in the last year and actually the last 2 years after lagging. The Bay Area is doing well. Dallas does well. And other sectors, other parts of the country, a little better, a little worse. Let's go to the next slide and we'll take a couple of looks inside the labor market. Median weeks unemployed, I put a blue line just to help you see the average over the almost the last 50 years. You can see that the weeks unemployed median skyrocketed way beyond previous cyclical highs. That was largely because we extended unemployment insurance for a couple of years, and as that ended, you started to see it coming down. We're getting near normal, but again, even though we're adding a lot of jobs, this would suggest we're not quite back to a super robust labor market. Okay, but not super robust. Go to the next, another look at the employment market, labor market. It's the working age population employment to population ratio. You can see in the red the longer term trend, which includes the 60s and early 70s, and the lighter blue trend line, which shows the average in the era when women were, quote, fully in the labor force, and not surprisingly, it's higher. You can see that this dramatically dropped during the recession and has crawled back, and it is crawling back. This is staying low, and it therefore overstates the strength of the labor market if you just look at unemployment, for example. And this is down probably a couple of million people because of the drug and especially the opioid skyrocketing over the last 5 years. There's probably been an increase of 7 to 8 million opioid cases in the last 5 years, and those people basically are unemployable. Can they not pass drug tests? Many of them can't function in the labor market. And it also reflects prime age males, sort of now 60 to 70, not working because starting a decade ago they took permanent disability and they're not coming back. And the third part is this, couple of recent studies have found as many as 1.5 million to 2 million, mostly males that are 18 to 34, sitting in their parents' homes, happily playing video games where they would have traditionally went to work. And that is sort of unprecedented. The number I'm mentioning is above kind of normal sitting at home. Let's go to the next, and we'll look at housing starts and auto, two drivers of the economy. Both housing and auto tend to be highly cyclical. They drop big during downs and they pick up big during up. Normally at this point in a cycle, auto would be 10 to 20% above norm. You see the red. It's only about 5 to 10% above norm, and in addition has to make up for a huge shortfall of production that occurred from 2008 through 2012. So yes, it's moving forward, and yes, it's at a pretty good velocity, but still has to make up lost ground. I think it's quite healthy. If you look at housing, whereas it's normally bounced back by this point, it's still way below normal. And that's due to the fact that you need a down payment for a home. You don't necessarily need a down payment for a car. That's why it bounced back. You do need a real down payment, real money for a home. And as we'll talk about in a moment, and as I've mentioned in my writing and all my talks, the low short-term interest rates has put an effective 100% tax on anybody with safe savings in 6 months to 2-year CDs. This has wiped out a primary source of savings for an income for down payments, whether it was the savings of a young household or it was the savings of an older household who would help the generation or two below them. And as long as that short-term rate stays low, the major source of down payments is being punitively taxed, and you have, therefore, a real drag on the ability to put down payments and, therefore, the ability to put in homes. Go to the next chart. You see the unemployment rate, both for the entire pool, that's the blue with an average line shown, and for the young, the 16 to 19. The 16 to 19 are a good barometer. They're much more volatile, as you can see. When things are good, it's very easy to bring them on, and when things are bad, it's very easy to let them go and not hire them. Been a terrific recovery in the 16 to 19-year-olds that are looking for work. They have to be looking for work to be here. So this does not include the drug, and this does not include the sitting at home playing games people. But if you're willing to look for a job and you're 16 to 19, by historic standards, quite good. And if you're willing to look a job and you are active among the entire workforce, it's good. And you get back to the problem is not those looking for jobs, but those who took permanent disability beyond norm, those who have drug problems, particularly opioid problems, and those who are sitting at home playing games who are not in. Go to the next. You can see that the weekly unemployment insurance claims, which is a very contemporaneous non-survey read of the strength of the labor market, shows very low unemployment insurance claims. Now remember, you had to be employed or looking for a job to be able to get unemployment. So it doesn't have the opioid, it doesn't have the disability, and it doesn't have the playing games people. But it's very low, near its all-time historical low back in the late 60s. So this is showing great strength, and it's why I think there's a lot of legs left in the recovery, along with the housing market and auto. Go to the next, and you see, let's take a look how the household sector's debt burden is relative to the ability to pay it. And crudely, I take household debt as a percent of real GDP. Just think about it. It's our debt versus what we have to pay it with, crudely. You can see it shot way off the red trend line from about 2000 until about 2008. It then has receded, gotten back to trend line, and is flattening out and starting to rise again. We're around where we should be, it would appear, in terms of household leverage. People ask, why is there an upward trend? The upward trend reflects improvements in capital markets. Very simple. Less racial discrimination, less discrimination against females and Hispanics, better capital markets that can provide deeper access, not just to high credit people, but to medium credit people at an appropriate price. That's the upward trend over time. So households in pretty good condition in terms of their debt burden. Go to the next, consumer confidence. Consumer confidence, the consumer looks pretty confident, and that big jump you see is November. It's post-election. There was a big jump in consumer confidence. It has continued. A lot of people thought it would last a month or 2 months. We're sitting here and we've now got the July data, and it's remained. It is starting to show in consumer behavior, but not right away. This is another indicator the economy's got legs, in my view, because normally consumer confidence is well above average. The red is the average, well above average for 3-4 years before it all falls apart. It's when you get that exuberance and you get excessive housing markets and you get excessive auto markets and you get excesses elsewhere in the economy driven by overconfidence. And the fact that we are early on in being overconfident means we're in the early phase of that. Not that it's good or bad, it's just that we're in the early phase, and I think it has legs. If you go to the next slide, same concept for small businesses. Small businesses' confidence collapsed during the crisis and was very slow to recover. You see a big spike again post-election in November. And businesses, small businesses in particular, have only had a fairly high level of confidence for about 6 months. It has receded very slightly. And, you know, again, people thought it would recede more than this. It is a driver of continued employment growth, and I think, again, provides a fair amount of legs. Go to the next chart. Corporate profits as a percent of GDP for non-financial corporations. By the way, you'd find a fairly similar chart if I include financial, but it's a little cleaner because the financial companies have much higher leverage ratios, and so it accentuates these movements. Some of you may have read Piketty and Saez, who saw the, among other things, the increase in profits as a percent of GDP from 2009 through 2012, and said it was a trend that would continue forever. And we said, I don't think so. History says that in the early phase of a recovery, the profits go to corporations because labor markets are weak and the beatings will continue until morale improves. But as labor markets tighten up, the profits disappear and the gains go to the workers. And that's exactly what's happened. Slightly above normal profits as a percent of GDP, but you can see it's moderating back down and is pretty close to normal. Go to the next. One of the other reasons I believe the recovery has another couple of years to go, normally banks have no excess capacity to make loans. Therefore, any hiccup that happens on their balance sheet directly hits their ability to lend. And so if you look at the red line, which is bank loans, versus the blue line, which is sort of their statutory capacity, any hiccup meant they had to reduce loans because they had to have a certain amount of statutory capital to meet their loan book, and if that capital fell, they had to reduce loans accordingly. As a result of QE1, QE2, and QE3, the bank loans grew basically on trend, but their capacity skyrocketed, so that at this point, banks have effectively $15 trillion of unused capacity. That means that they could have, quote, balance sheet hiccups and still be able to lend without having to make dramatic changes. And that's unprecedented, and again means not that banks might not overreact. We all overreact at times, but rather that they have a lot more cushion to react than they've ever had in the past. This cushion is a result of QE1, QE2, QE3, and stress tests, which are black box regulations imposed on the major banks that have made them keep lots of excess lending capacity, lest they fail the stress test. Now, I think the banks would like to have less of this excess capacity. You can see they're trying to work it down over the last few years. I think that will continue, but they have a tremendous amount of cushion so that the normal balance sheet hiccup, I don't think, will echo on as we've seen in the past right away. Go to the next chart. Let's look at the real economy. Let's see what, forget, Keynesian and so forth. Let's think of real businesses. You grow more when you have a better investing environment, when you know the rules of the game, when you get to keep more of the money yourself, and when you spend your time being productive rather than lobbying and paying for lawyers. So one measure is how many new federal level business restrictions have been put on. And you see during the Carter administration about 25,000 a year. During the Reagan, that dropped to 6,200. with none in the first 5 years, a zero net change in the first 5 years. Bush Sr. was very much like Carter. You saw it jump back very quickly to $25,000 a year. President Clinton was, in his 8 years, was very similar to the Reagan, which was about $6,200, and in fact, over the last 4 years of his term, it was slightly negative. So the $6,200 was the average. Bush Jr., very much like his father, and Jimmy Carter. And the Obama administration was very active, but not as active, interestingly, as Carter and the respective Bush. This is important. We're going to keep track of this. We'll get the number at the end of this year. My instinct is that it's going to come in at around 3,000 for this year, which means there is a reduction in regulation. And I think over time that will spur more innovation, less lobbying, less lawyers, more money going into productivity. Let's take a look at the capital markets. You see the 10-year in the next chart. You see the 10-year Treasury in red. It's 10-year Treasury yield in red, and the federal fund interest rate in blue. You see the dramatic, and I say that sarcastically, increase in the Fed's funds rate that's happened as the Fed has increased interest rates. If anybody on this call had your business put at risk by those kind of increases in the blue, you're in the wrong business. I mean, if I was talking to guys running highly leveraged hedge funds or, you know, something like that, perhaps. But in our business, those changes mean nothing. It's good news, actually, in that it means safe savers, think of 6 months to 2-year CDs, are getting more income. Yes, the borrowers are paying more, but the lenders are getting an exact amount more. That's just a transfer payment between the two. People often say, yeah, but it's going to cost more to borrow, and people will therefore have less money. Yes, but somebody else has received the income, and they have more money to the exact same amount, and the capital markets are less distorted. Interest rate environment is still very low, and there's very little penalty to holding cash as long as interest rates are low. If you go to the next chart, you'll see the red is the long-term trend in cash holdings, which is checkable deposits and currency held by businesses and individuals. And you see the blue, which is actual. And we went from kind of around trend line to about $2.3 trillion in excess cash holdings. Think about that. If you don't penalize me for holding cash by having an interest rate and returns on investment that are attractive, I'm going to hold more cash. Why not? There's nothing wrong with holding cash, but we're talking about beyond the norm. $2.3 trillion beyond the norm is earning and producing nothing productive over those years. If you think about $2.3 trillion, which is the current amount, it was lower in previous years, $2.3 trillion, if it was generating a 10% return, that is instead of sitting in cash, it had been put to productive use, that's $230 billion on an $18 trillion economy of additional growth. And you can work backwards. That is a huge amount of growth that's been lost simply by the disincentive to invest created by low interest rates. As we always do, let's go now to the real estate sector. I'm going to move quickly through these. I'm going to show you first, the next chart is commercial and industrial construction measured by footage, and you'll see the high marked, the low marked, and the average marked in red. We made a big rebound. We were rebounding very quickly. In the past, we blew right through average. And you can see that the pullback in development lending that occurred at banks about 9 months ago tapered the amount of construction contracts that are underway. So yes, you can find pockets of overdevelopment, but all told, pretty restrained in terms of footage. Now we're going to go, and I'm going to go through each sector very quickly, of real commercial construction dollars. So you can think of as a combination of footage and how much money I'm putting into it adjusted for inflation. So if I'm building better buildings, the dollars will be higher even if the footage was to be flat. So we look at commercial construction as a whole in the next chart, and even though the footage is average, the dollars are above average, which means we're building better buildings, more expensive, more build-out buildings than in the past. And that's a lot of tech that's going into these buildings versus in the past. We're not at an all-time high, but given our footage, we're quite high. Now I'm going to go quickly through office. Next chart shows the same thing, dollars of office construction. You're going to see high, low, and average. And you can see office dollars are a bit above average, but well below peak. And in fact, footage is right around average. It's not shown on the chart, but it's true. Go to the next chart, you see the vacancy rate for institutional quality office properties. Gotten pretty healthy. You may remember some people in 2009 said no one would ever rent offices again and it was going to disappear. We said no, it's cyclical. The cycle is playing its way through. We're back down to fairly healthy vacancy rates. Go to the next, real office rent. This is a national number. Of course, every market's different. But you can see right around its norm in real terms, way below its peak, way above its trough. So the real rent you're getting still has some cyclical room to rise and probably will do so given some of the pullback in development. Go to the next chart and you can see adjusted for inflation, the real office values, a little bit above norm, 5–10% above norm. Rents a little above norm, but construction a little below norm, probably justified. You can find, again, excesses, you can find opportunities, but not nuts. Go to the next and we'll do the multifamily quickly in the same way. Multifamily construction, pretty much near its all-time peak. It has flattened out as the financing is pulled back from, say, 75% loan-to-value on development to 70% loan-to-value. So it's flattened out, but still quite high. If you go to the next, you'll see the vacancy rate for institutional quality properties bouncing around normal, but the best times appear to be behind us. That window of very low vacancy of 2012, 13, 14, 15, 16 probably is behind us, and we're going to bounce around healthy, around 5.5%. Go to the next, multifamily real rent adjusted for inflation. Now remember, we're building better and bigger units in better locations over time. And you can see it's at an all-time peak. Rents have spiked and they remain near an all-time high. I think they're going to soften. They're going to stay well above average, but soften a bit over the next 3 to 4 years. Obviously, a lot of that depends on construction over the next 3 to 4 years, but I think you're going to see some softening back down towards the average. Go to values on the next chart for multifamily, well above average. Low cap rates, high rents, high occupancy, people applying cap rates on that fundamentals. It's pricey. It is not the priciest it's been. There's a little pullback, but it's definitely pricey. Go to industrial. Industrial construction bouncing right along at peak. A lot of property being put in place, particularly for e-commerce logistics. Well above average. The industrial vacancy rate, the next chart, for institutional properties is what's driving that construction. Namely, that construction being driven by very low vacancy rates. The space is being absorbed that's being built. So the absorption rate is quite strong, and I think will continue for a couple of more years. Go to the next chart. Real rents, kind of around average. So you've got a sector with average real rents, strong occupancy, and that's what's driving a lot of construction. We could overshoot this, and if you go to the last chart of that series, you'll see the industrial value above average, and above average probably by about 15%. And that's the average real rent and below average vacancy with good cap rates driving that. I think that'll moderate over the next several years in real terms. Let's go to retail very quickly. You'll see retail not near its, it just kind of still below average. People say retail, is in trouble. Not much retail has been added. This includes, by the way, TI dollars and renovation dollars. And in fact, most of the recovery has been renovations and TIs. If you go to the next chart on vacancy, in spite of the headlines, you would think on the headlines that retail vacancy is skyrocketing, it's going out of sight. You can see it's right around average. It's picked up very moderately, but it's done a pretty cyclical kind of recovery around normal. You go to the next chart, you can see, though, rents struggle. They're staying along the bottom. So you've got rents down in real terms. You've got normal occupancy. You've got constrained construction. If you go to the next chart, values were pricey and have gone back down to about normal. Now, I think some of that is a massive oversell-off on internet hype. If you go to the next chart, you'll see the category internet and mail order sales, which is a combined category. And of course, prior to about 2002, there were no internet catalog. So if you took the trend from 92 to 2002 and you just extended it, you get the red line. And it gives you a sense of true internet growth, not just catalogs would have occurred and maybe internet is disintermediated catalogs. And it's about $15 billion. It's a real number. It's a growing number. But first of all, it's not as big as it looks because the catalog would have been a big chunk of that anyway. And people forget how much of it is just replaced catalog. I want to give you just a couple of food for thought, nothing else on the next four charts. It's Amazon versus Walmart, and I simply show, first of all, their market capitalization adjusted for inflation. And you can see Walmart drifting down over time as its multiple has fallen, even though its sales have grown. And Amazon has, even though it's been around since 2000, it's hardly a startup company, its market capitalization has just skyrocketed since 2009 and especially since 2015. Let's take a closer look at that. If you go to the next chart, let's look at their profits adjusted for inflation. And in its history, which is a 17-year history here, Amazon's basically never made profits. It's really only made profit, if you look at it, in the last 2 years. And the rest of its history has been, trust us, will someday make a lot of profit. Walmart, on the other hand, has made a lot of profits. Its profits have diminished. Basically, what's happened is its profits have remained the same, and inflation means its real profit has fallen. So the purchasing power of that profit has fallen. Now, the next two charts are just food for thought. I picked a particular day. The day is irrelevant. It gives you a sense. The next chart shows Amazon versus Walmart, something to think about. Earnings per share. Amazon, over the last 4 quarters, $4.90. Walmart, $4.57. Walmart's EPS multiple was about 17. Amazon's was 210. It's gotten as high as 260. 260. You think about that as a cap rate, and it's stunning. The enterprise value of Amazon is about 50% greater than that of Walmart, even though its sales are only about 30% of Walmart's. go to the next chart. I did a math exercise, and it's just math. And I asked, how fast does Amazon's earnings per share have to grow over each year for the next 10 years if it has no share price appreciation to justify a 20 multiple? So think of it this way. Amazon's price doesn't change. How big do its earnings have to be 10 years from now when it's a mature company and has a 20 multiple? How fast do its earnings have to grow? And the answer is it needs every year for 10 years a 20% profit growth rate. Now, by the way, in that time period, Walmart or any company that's already a 20 multiple company would be generating massive earnings in excess of Amazon's. So I took Amazon versus Walmart and I said, gee, if Walmart's earnings remained flat and its share value remained flat for the next 10 years, how long does it take Amazon to make up? How much do its earnings have to grow to make up for what I could have gotten with Walmart? The answer is it takes until 2033 at 20% per annum. So it takes 16 years of 20% annum growth to give you the same profits that Amazon would give you between now and 2033 if their profits don't grow. By the way, if you do it in present value and use any kind of realistic discount rate, it requires until 2050 to get the same profits from Amazon as you would from Walmart. This is not pro-Amazon, pro-Walmart, or anti-Amazon. It's just food for thought. When you realize that in present value terms, you're talking about 33 years from now, and you think of what can happen in 33 years, it's pretty staggering the bet people are making, the market's making. If Walmart or any company that you would compare them to with a 20 multiple does a little bit better in their profits and it grows, or Amazon stumbles even a little and only grows at 18% per annum for the next 33 years, it gets closer to a half a century. Food for thought. Let me head to the finish line, Bruce, by looking at hotels. And hotel construction, you'll see on the next chart, is above average. Go to the next chart. Its occupancy rate is basically at all-time highs, which has been driving the above-average construction. If you go to RevPAR, the revenue per available room, in real terms, it's at an all-time peak. Interestingly, the market, if you go to the next slide, is pricing record high RevPAR, record high occupancy, and a bit above normal construction, right about average. And there's a fundamental understanding that this is a highly volatile sector with tremendous operating leverage, and when it falls, it falls. Let me go to the finish line with, again, just a couple of foods for thought. You hear a lot about the federal debt and the deficit and the taxes and what should we do, etc. I want to just show you two charts just to think about. The first is federal debt held by the public. That's us, including foreigners. It just nets out if the U.S. government holds its own debt. And it goes back to the founding of the country and shows outstanding federal debt as a percent of GDP. So not surprisingly, after the Revolutionary War, which was financed with debt, it was high. We paid it down, got to about 0. We then had the Civil War, which was paid with debt. We then worked it down to about 0. We then had World War I. And all you're saying is when future generations are at risk, we've borrowed against those future generations to pay for it. We start paying it down. The Great Depression came along, and we borrowed against the future to pay for it. And then World War II came along, and we really borrowed against the future. And then you can see we started paying it down, but you get Vietnam, and you get a little bubble there, and you get a little bubble from the terror wars happen, and we start paying it down. And then you see the explosion that was associated with the crisis, and the current Congressional Budget Office forecasts of what happens based largely on baby boomers retiring, at which point they stop paying Social Security, they stop paying FICA, they start taking Social Security, they start taking Medicare, and also the explosion in Medicaid, which has gone from a medical program for the indigent to essentially a medical program for anything we can't fit under Medicare. And you see that we are at levels of burden that are going to very quickly approach World War II, except unlike World War II, it won't end. And there's a fundamental problem that's going to have to be dealt with to, quote, end it, as it were. We've overpromised. If you go to the next chart, very simple disentanglement of 4 categories of what the federal government spends on. So this is the pie chart. So this, if the government is always spending a dollar, back to the beginning of the country. In the beginning, the dollar was being spent repaying that debt. That's the purple, was being spent repaying the debt. Not much was being spent on other things, and nothing was being spent on Social Security or health care. Defense was a big number because we were a small and fragile country. You go through history and you see that defense was a big, big portion of what the government spent on, especially during fragile times, during war times, etc. You see the interest disappears and then reappears, and then everything else. But you really don't see spending on Social Security or health care until you get to the 1930s. And suddenly you see the green and the yellow. And the green and the yellow explode. And these are sectors we never had before in history, and they're the generational challenge of we invented in the basically 30s and expanded, particularly since the 70s, these categories, but we've not gotten rid of the others. With that, I would end on the last chart and simply say we're no different than we were a quarter ago in terms of the canaries in the coal mine. We've got some dead canaries, we've got some live canaries. The recovery is going to continue, I believe, for a couple of more years. And with Bruce, I'll end, and we'll take about 10 minutes of questions.
Okay, great. Thank you so much, Peter. Appreciate it. All right, so just taking a look at the questions here, and you know, a lot of people who have written in are wondering about you know, when are the good times gonna end here. I remember, Peter, when you had Sam Zell in to campus in 2003. This is at this point a long time ago. And Sam was talking about the state of the market, and he said, you know, when I go out on my balcony and I look at the skyline of Chicago, I see too many cranes. And that was basically presaging what was going to come in the next couple of years in terms of oversupply and the peak. If Sam were to go out on his balcony right now, does he see too many cranes, or are we going at an appropriate pace here?
We see about the average number of cranes. And remember, we need some cranes to deal with the growth in population, the growth in employment, the growth in sales. We do need cranes. And what you see in most markets is about normal. it seems more than normal because cranes basically disappeared, as you well know, by 2010, 11, 12. And when you got used to seeing no cranes, it's like, wow. So, yes, there are cranes out there, but they're basically around the normal number. By the way, if I tell you they're around the normal number, that means some markets and submarkets have too many. And I think particularly notable in that regard are New York hotels. Particularly notable in that regard are urban infill apartments. Suburban areas are growing faster population than urban infill, and yet we're adding more urban infill apartments than we are suburban, even though the urban infill rents are softening and absorption softening. So you can find areas of excess, both geographically, submarkets and markets, and product, but that also means that the overall is about the average number of cranes. There are windows that are underbuilt, and I think you can absolutely find those as well.
We have some folks who have written in regarding the proposed termination of LIBOR. Any initial thoughts on this?
Well, it's at one level, it's not important at all. LIBOR is artificial, and it's simply a metric of short-term rates, and its main advantage is that it was daily and not too volatile because it was a manufactured rate where they threw out the high and threw out the low. So if you think about it, it was this arbitrary benchmark that said we want volatility, but not too much volatility in reflection of the short term. So in and of itself, the disappearance of LIBOR would not be a problem because you could go to the Fed funds rate. You could go to back to prime, where we had been in the old days when I'm young. You were at prime. You could go to 30-day Treasury. You could go to 10-day Treasury. The problem is a bit transitional. Namely, there are a bunch of contracts out there that specifically refer to LIBOR. And if LIBOR no longer exists, what should those contracts use? So it's very easy for me to say as a big matter, it doesn't matter, because on a new contract, you'll go to prime or you'll go to 30-day Treasury. It is a big matter for me if my contract's in LIBOR and LIBOR no longer exists, because I know my lender is going to assert one benchmark that will favor them in the near term, and I'm going to favor another. So a lot of to do about existing contracts, not much to do about going forward contracts.
So we've seen in the slides, you know, in a comprehensive manner, a lot of good news, a lot of good signs. What's your personal biggest fear in terms of the real estate market going forward? I mean, it's been good for a really long time.
It's interesting. I tend not to be a big involved in development, but a bit. If I am a developer, the biggest negative I see is that the banks are maintaining quite good discipline on lending, and with high levels of regulatory scrutiny, they will continue to, in which case developers will have opportunities, but not staggering. If I'm an owner of existing property, I go back to your Sam Zell comment, which it's the exact flip of the coin I just described. Namely, the biggest fear is that banks lose their discipline on development lending. Great for developers, bad for existing properties because we'll overbuild too many cranes. I also worry at some point we need to have a clearer tax code and a simpler tax code, but we can muddle by without it. And at some point, we need an improved school system because human capital is what ultimately drives absorption long term. And we continue to muddle by with not a great school system. So in the near term, I think the concern is watch lenders. In the longer term, it's this fundamental, the tax code gets more choking every year, and the education system's inability to produce high-quality human capital across the board, not just for Ivy League, right, across the board, is a big challenge.
Peter, on the topic of tax reform, several folks have written in about 1031s. Can you comment on that? Potential changing in that market?
I mean, there's nothing new. 1031 exists because stockholders are able to exchange shares for shares and protect their tax position, and people with partnerships have always argued, therefore, I should be able to. That intellectual is still true. When they go looking for revenue, they always look at 1031. They get a flurry of, okay, we're going to get rid of 1031. They then step back and say, oh, but that disadvantages lots of partnerships relative to stock ownership, and they back away from it. Absent a sweeping tax reform, I think it survives. I think you need a 1985 kind of tax reform where everything, interest deductibility, depreciation schedules, exemptions, everything is on the table. That's when 1031, I think, could be at risk, because everything could be at risk. As long as they continue as they have for the last 32 years to incrementally do it, it'll get talked about, but I don't think it gets knocked out.
Okay, we've got time for maybe two more questions. Several folks wrote in about retail and regional malls. What's your general view on regional malls? Are we over-malled, and what's going to happen to those properties?
The answer is we're over-retailed, both malls and strip centers and boxes. That's been true for probably 25 years. It has become more true, not so much because of online, but because those leases that were signed in that over-retailed space 20, 25, 15 years ago has either expired or the tenant has gone out of business through the ravages of competition, including online competition. Therefore, the fact of excess has become more and more present. We have a shortage of great retail, namely well-located, well-tenanted, well-designed, and we have an excess of poorly designed, poorly located, and poorly tenanted real estate. It reminds me of almost back at Wharton, Bruce, we had a shortage of extraordinary students and a surplus of not so good students, right? And overall we had, I don't know if we had too few or too many. I think retail is the same way. There's an absolute shortage of tremendous retail. And if I own that, I love it. And if you look at the performance of the good strips and the good malls that show the shortage of product, they're doing quite well. If you look at places that are in over-retailed areas, they're doing poorly, and they were doing poorly with or without the internet. The internet might be speeding it a little bit, but there's not enough dollars in internet to kill them. It's the fact there was too much poorly tenanted, poorly designed, poorly located. Neighborhoods have changed, travel patterns have changed, shopping patterns have changed. So death is, I remember Milton Friedman comment, like on the first day of classes, about competition. And his statement was, competition is not about determining who wins. Any system can determine who wins. Competition is about letting losers lose. And what you're seeing happen in retail is winners winning and losers losing. And that was set in motion 25 years ago when too much retail was being built, and then was worsened as Walmart put in their standalone superstores and made even more of it irrelevant.
Thank you so much, Peter. Unfortunately, we need to wrap up now, so we're not going to get to all the questions. And I just want to make everybody aware that today's hour-long presentation is really just a digest of what's presented in a lot more detail in the Linneman letter, which is a quarterly hard copy subscription from Linneman Associates. And you can find more information about that on the Linneman Associates website. Also on the website are a free 50-part audio interview series with Peter on real estate, and a link to a video series that Peter did with BizNow Media. The website address is linnemansociates.com. Thank you to everyone for joining today, and we hope to see you back next quarter. Have a good afternoon.